too lazy to head down to a bank branch to carry out banking services, we might not need to do that in a couple of years, such as these and these. The MAS has granted 5 digital banking licenses, of which up to 2 will become digital full banks as long as the companies are based in Singapore and are controlled by Singaporeans. These banks will be able to serve retail customers. The remaining 3 can become digital wholesale banks, which will be able to serve small and medium enterprises and other non-retail segments and are open to foreign companies as long as they are locally incorporated. So basically, 2 licenses to serve individuals like you and me, and 3 licenses to serve companies and organizations. But what is a digital bank? Based on what I've researched in my personal banking module previously, a digital bank offers identical type of banking services as a traditional bank would, except it operates entirely online without any single physical presence. The bank is built on the value proposition that most products and services are delivered digitally and that customers expect to use digital channels for their day-to-day banking activities. A common misconception of digital banks are that traditional banks' online platform, which is known as online banking, instead. Online banking refers to banking services where depositors can manage more aspects of the accounts over the internet rather than visiting a branch instead. It is not a digital bank. Back to the topic, conditions for digital banking license include wholesale banks are not allowed to take deposits from retail customers except for fixed deposits of at least $250,000 and must have a minimum paid up capital of $100 million. Singapore dollars. What is paid up capital? It is the amount of money a company has received from shareholders in exchange for shares of stock. It is created when a company sells its shares on a primary market directly to investors. Digital banks can operate without any physical branch or teller machines and do not need to worry to have a history in the banking business to apply. Now for requirements by the MAS in the digital banking licenses. At least one entity in the applicant group has 3 or more years of track record in operating an existing business in the technology or e-commerce field. Key persons in the group are to be fit and proper, so they're not to be corrupt, etc. Applicant demonstrates ability to meet applicable minimum paid-up capital requirement on onset and the minimum capital funds requirement on an ongoing basis. The value proposition of the applicant's business model must incorporate the innovative use of technology to serve customer needs and reach underserved segments of the Singapore market. That differentiates it from existing banks. MAS will also consider the ability of the applicant to implement the proposal. Lastly, applicant must have the ability to manage a prudent and a sustainable digital banking business, including the level of understanding of key risks in a banking business and strength of its regulatory compliance and risk management plans. MAS will also consider the reputation, track record, financial strength, and commitment of the shareholders of the applicant shareholders. In my opinion, MAS is trying to make the banking sector more competitive by offering these new licenses. This pushes incumbent or your traditional banks to research on how to stay competitive and retain their customers. Some incumbent banks may also adopt a digital banking model as well to cater to those who prefer the more seamless banking road. I believe MAS also wants Singaporeans to enjoy the benefits of more seamless and tailored products that may only be the fruit of digital banks entering our economy. Digital banking adopted by incumbent banks can potentially bring theoretically faster and more convenient banking services, lower operating costs, better analytics and recommendations. They can also take advantage of their solid track record, large existing customer base, and years of experience crafting products and marketing campaigns that resonate with their customers. They also have generally more responsive customer service, something which other tech companies that are looking into digital banking may not have. However, a solely digital bank has its own advantages as well. They can pick their own target customer group, do not have the huge organizational structure that incumbents have to manage, and are able to recruit a mix of talents to power a modern, powerful, and cost-effective infrastructure. They also do not have to deal with legacy systems that incumbent banks like the upgrading and retraining of staff. These advantages balance out the advantages of incumbent banks that are looking towards adopting a digital banking approach. This makes the banking industry more competitive and hopefully better products tailored to customers can be made. So what is sustainable digital banking? A sustainable digital bank business model is one where the bank optimizes its customer interactions, products, processes, and data around digital technologies. Examples of successful digital banks are ones that appeal on the front end and are also digitally efficient on the back end. They use mobile and digital technologies to lower the costs to serve and also use these technologies to enhance higher touch services. A digitally sustainable bank must have digitally optimized interactions where customers conduct most of their basic financial transactions and should be at the center of every bank's distribution strategy. A sustainable bank must also have digitally optimized products designed so they can be easily purchased and serviced on digital channels. It must also have digitally optimized processes like digitizing user signatures and forms for a paperless environment to aid in customer journey so that customers do not feel disconnected from the bank when they do business with the bank. Lastly, a digitally sustainable bank must have digitally optimized insights needed to develop the capacity to sense and rapidly respond to the customer's increasing demands and unpredictable patterns of banking behavior, perhaps by devising a way to use customer insights in real time. Digital channels are indeed ideal for some activities while face-to-face interactions are still needed for others. Banks need to excel at both by providing the convenience of digital channels when convenience is needed, and engage with customers intimately when a personal touch is valued more. This makes digital banking truly sustainable. To address the problem of competitiveness and tailoring of products for banking consumers, a fully sustainable digital bank is the answer. When you combine convenience with digital channels and personal touch of meetings and consultation, you can help attract, retain, and cater to customers. Also, seeing that you have taken an approach to cater to them, customers are likely to continue banking with you and you will stay competitive. Now, what happens if you do not have a sustainable digital banking business model? Well, simply put, they are likely not able to retain their customers and may lose out to competitors or new entrants. They may lose market share. This is because they may be too focused on going digital or having a balance of both digital and traditional. They may not be able to understand the needs of customers and tailor products accordingly. Let's talk about the pros and cons of digital banking in the perspective of banks and clients. Firstly, to create an account from a digital bank is very cost effective and may cost as little as $30, whilst to create a traditional bank account can cost up to the bank up to $150. This means that a digitalized bank can afford to spend more capital elsewhere to tailor better products for their clients. With digital banking, paying bills online is done much easier since all of your information is tracked through your banking application and payment is a click of a button. This saves and brings convenience to bank customers and is very time and resource efficient. Digital banks potentially linked to technology firms and with access to a wide range of customer data may also be able to better serve a broader range of customers by assessing their credit profiles using non-traditional data. A statement by Fitch, the credit rating firm. Digital banking also allows for access to account history and transactions anywhere, making protection incredibly easy and having access to you regularly check your account, preventing fraudulent charges from getting out of control. This also makes it easier for banks to audit or check your account. Now for the cons. Digital banking itself, as its name suggests, is digital. This means that it's definitely subjected to security breaches. This is a major problem for both banks and clients, as without a proper rigid structure and around-the-clock security, clients' sensitive information may be compromised, and this may lead to the bank getting sued, a loss for both sides. Another disadvantage would be technical disruptions and glitches where clients are unable to access their banking services, and this leads to the bank losing potential business and relationships. Lastly, a disadvantage would be that some elderly clients who are tech-savvy may not be able to understand how to navigate and carry out their banking via a digital platform. This could mean that solely digital banks may not be able to reach a certain target group of clients. In regard to MAS's issuance of digital banking licenses, the Hong Kong Monetary Authority (HKMA)'s guidelines are prescriptive, focusing on technology risk, outsourcing, and general risk management. Hong Kong's framework is comparatively light, stating simply that digital banks will have to comply with risk-based capital and liquidity requirements. This statement means that Hong Kong is exploring the possibility of digital banks, but are not as stringent and did not regulate it as heavy as Singapore. They are probably taking a more relaxed step that allows digital banks to enter the market more naturally, and maybe regulate it more strictly later on as they deem fit. Supposedly, Hong Kong's financial sector is likely to be disrupted sooner than Singapore, as fewer regulations are needed to be met. This, however, does not seem to be the case, as the political and civil unrest in Hong Kong currently is likely to have inhibited the launch of several digital banks. This is because the people of Hong Kong are likely to not have making a bank account as one of their current priorities right now. Singapore, on the other hand, is probably wanting to set up many restrictions to protect the interests of Singaporeans. They may want to ensure that the digital bank license holders can sustain being a business in Singapore, and that clients' assets and information is kept safe with the digital banks. MS also wants to ensure that the entry of digital banks will help Singapore's financial centre grow, as well as not only monopolize the banking industry. With the MAS slower approach to adopting digital banks, where they will first limit the digital bank's deposits, type of the products and customer base before giving a full-fledged banking license when a digital bank's risk management and compliance is up to MAS's standard. Paid-up capital required by MAS starts at 15 million Australian dollars and skyrockets to 15 billion Singapore dollars when the digital bank is given the full-fledged license. Hong Kong, on the other hand, only requires roughly 52 million Singapore dollars in paid-up capital. This means in the short term, digital banks will not stick out too prominently amongst those banking in Singapore. Digital banks will likely try to first gain intel on how to make products suitable for Singaporeans. Maybe once they have started to gain trust and receive the full-fledged banking license, we will see digital banks coexist with our traditional banks in the long run. This could mean potential influx of jobs available in the banking sector too. Regarding MAS's value-destructive competition in a statement by MAS, I believe it refers to an individual or company practicing price manipulation such as predatory pricing to increase market share and lower business volumes and profitability of competitors. Such competition is unhealthy and may affect jobs and people working in the financial sector of Singapore. This, of course, is condemned by the MAS, thus it stresses the need for applicants to not practice such form of competition as a requirement in their application. Should a bank gain market share through value-disruptive competition, it may lose sight of their main purpose, the purpose of a bank, to provide for and serve their clients. This is cognitive dissonance. The bank may end up making products that are cost-effective and profitable for them, but does not provide the value, service, and relationship that customers are truly looking for. This may snowball into an increasing distrust in the banking sector and will not benefit the society in any way. In conclusion, this latest decision by MAS sows the seeds to a new generation of banking, digital banking. This is to promote healthy competition within the financial sector and provide a new platform for seamless banking. Sustainable digital banking, a requirement for the digital banking license, has to be adopted to ensure that the digital bank can maintain a stable profitability whilst providing lasting benefits to clients. Digital banking is beneficial to both the clients and the banks and thus have its flaws. As you know, digital banking is efficient, convenient, but risks security breaches and glitches if proper measures are not taken. MAS issuance of digital banking licenses is to first test the waters by giving out probationary licenses before handing out full-fledged licenses when they feel that the bank has adequate risk management and can maintain a sustainable digital banking business model. Short-term wise allows for banks and tech companies to prepare to go digital and in the long term provide jobs and services to potential banking clients. Lastly, value-destructive competition refers to individuals or organizations manipulating prices and products to increase market share and lower business volumes and profitability of competitors, and this causes cognitive dissonance. I hope you learned something new today, and I thank you for watching.